Meta Platforms reigniting the AI trade after the company announced their Q1 earnings. We not only got earnings and revenues and cash flows from Meta, which we'll get into on today's video, we've got a technical pattern that is looking absolutely beautiful, even in the after hours as shares are popping just a little bit. You probably got a buying opportunity with Meta. We'll discuss that. We also got the all-important guidance for the upcoming quarter. How does that relate to what Wall Street had planned for Meta? Is the ad business falling off because of tariffs and potential Chinese competition pulling out of the marketplace? Also, we've got the all-important CapEx number for Meta. How did it relate to the previous outlook that the company gave just a couple of months ago? Is the AI trend slowing down, or are we putting our foot on the gas and we're accelerating? We'll discuss all of that and more on today's video. What is going on, investors? Hopefully you guys are doing well out there. If you've owned Meta Platforms over the past year, you're up 26%, but by a lot of stocks, down about 6% this year. If you're wondering, hey, Colin, it's earnings season, where are all your earnings videos? That is because the Equity Empire Premium subscriber is getting access to all of that. And we are posting daily videos as those earnings launch. Lots of great opportunities in this market. You have a lot of idiots thinking that the AI spend is slowing down, and Meta said, psych, it's actually accelerating. Meta is saying that their CapEx spend, which is essentially data center and AI, is going to increase to $64 to $72 billion for the upcoming year. The previous outlook was for 60 to 65. So not only coming in close to the high-end guide of 65, but they've expanded it out to 72 billion as the company launched a standalone app this week to compete with ChatGPT, Grok, Gemini, and DeepSeek. Last check, it's rocketing up the charts over at Apple. Now, getting to the Q1 results, revenue grew 16% year over year to $42.3 billion. The company also gave us guidance for $42.5 billion up to $45.5 billion for the upcoming quarter. Wall Street was expecting a number close to $43.8 billion. So Meta coming in the midpoint, somewhere in the kind of $43-44 billion range, more or less in line. There were some concerns that the Temus and some of the Chinese sellers, they were going to pull back on ads over at Meta. Here's the thing to understand about Meta is it's an auction format. So if the Temu is pulling away, and understand, Temu is going to pull their ad spend here in the United States. They obviously advertise globally. So if Temu makes up a percentage of ad spend on Meta, it's only a percentage of that is actually getting shown here to the United States. You also have to remember that Temu is outbidding somebody for that ad slot. So as Meta sees advertisers pull off the platform, there's somebody else that's stepping in there and that wants that traffic. Meta proving that their business is resilient. When you start to look out for future quarters, I think you have relative confidence that the company is going to meet these expectations. Kind of very low double-digit growth. It's a relatively low bar that the company has in terms of crossing that. Now, when you get over here to the financials, I mean, it is unbelievable. $42 billion worth of revenue. What I did notice was headcount. Now, Mark Zuckerberg and many executives inside of tech are saying, look, within a couple of years, all our coding is going to be done by AI. We're going to have AI agents, design the code, fix the code, write the code, and do all this stuff. So we're not going to, I guess, have a lot of software engineers. Headcount over at Meta, though, ballooning to 76,834 employees. That was 11% year over year. So is it being priced into the stock that this headcount will at some point diminish because of AI? Or is Meta going to have these workers work somewhere else? That's obviously something that we're not really sure of at the current moment, because you see over the past year, research and development up from $10 billion up to over $12 billion, but marketing and sales not budging a lot, 2.5 up to 2.7, and then the general administrative, you're just slashing that cost. $3.5 billion down to $2.3 billion. So your total cost over the past year went from 22.6 up to, we'll call it $24.8 billion. That gave you income from operations of $17.6 billion. Last year, it was 13.8. So we added $6 billion to the revenue side, and about $4 billion, little less than $4 billion, flowed to the income from operations. Obviously, your net income impacted positively by that as well. You come over here to the balance sheet. It's a big tech balance sheet. You got a boatload of cash over at the company. Obviously, these companies are investing a lot inside of owned data centers, and so the property, plant, and equipment continues to get ballooned as you spend money on this CapEx, which I'll show you here in a moment. It basically comes over here on property, plant, and equipment, but you got plenty of cash over at this company. Total current assets sitting at just $90 billion. $90 billion. You got a little bit of long-term debt, $28 billion, but obviously that is manageable when you have $90 billion of cash flow. For 3 months ended on the operating cash flow, the company added, like we said, roughly $4 billion, a little over $4 billion of net income. A little over $4 billion comes down to operating cash flow. That's because you have depreciation and you have stock-based compensation. That gives you, for a 3-month period of time, $24 billion of operating cash flow. So when the company tells you, hey, investors, we're going to spend $64 to $72 billion this year, and look at this. They spent $13 billion of CapEx in the most recent quarter. So this is going to rapidly accelerate as we get through the rest of this year. Because if you annualize out a $13 billion number, times that by 4, and you're at a number under $60 billion. So the company is telling you for the full year, we're going to spend $64 to $72 billion the back half of the year for NVIDIA, Broadcom, many other network providers. They're going to be raining money. That is because companies like Meta and many others are going to continue to ramp up their CapEx spend as we move through the rest of the year. Last year, they only spent $6.4 billion. Looks like a small number at this point. These larger CapEx numbers will weigh on the stock a little bit because there are some people that have to rely on cash flow models and they want to take this number and minus it by this number and then value the stock based on that. So some people will actually view as the acceleration of AI spend as a negative for Meta. That's why you want to probably have some exposure to Meta, but you want to have a lot of exposure to the semiconductor industry. That is because this number flows directly onto those companies' revenue and profit lines. Now, in terms of what they're doing with the excess cash flow is they are, like every big tech company, buying back the stock. $12.8 billion in the most recent quarter, a little bit of a slowdown compared to the December quarter, or last year's quarter in March. And then finally, you are all getting some dividends, which continue to be raised over at Meta. This will become one of the great dividend growth stocks of your time. So if you're wanting to hold the stock for a very long period of time, and then one day kick back and retire and collect those dividends, well, you want dividend growth, and that will be the case with Meta over the many, many years. Now, one thing that we've always pointed out over this company is the Reality Labs business. Year over year, you've seen a decline in revenues from 440 down to 412. I think they should rename Reality Labs like AI Reality or something, because look, it continues to bleed money. $3.8 billion of losses last year, $4.2 billion of losses this year. But you do have some things like the glasses, which are interesting. There's some AI stuff built into this. A couple of years ago, this was more like metaverse and kind of stuff that certainly wasn't going to pan out from an investment standpoint. Now it's still hurting the company from just kind of an operating profit perspective, but there are some signs of life there when it comes to maybe some potential products. I'm seeing in the after hours, Meta's popping by about 4.5%. Doesn't really matter too much because you've been in this very steep uptrend. And aside from kind of the real massive dip after they kind of took a turn to the metaverse over at Meta, you've pretty much been on this trend. Depending on where you want to draw this in, more or less shares have been going up outside, again, the massive drop. Things are looking good in the shorter term. You've just made a new higher high back in February. You've just confirmed a new low or a cluster of lows back here in April. Luckily for you, the investor, they didn't get below the lows that we made back in 2024 down here at about 430. This was a great buying opportunity. It may or may not have been one of the stocks that we recommended over on Equity Empire, as subscribers over there get alerted when profit opportunities come about. Meta looking absolutely solid in the after hours. The AI trade looking absolutely amazing. Not only this year, but the back half of the year is going to be absolutely spectacular. Investors will be pricing that in. Any weakness in those stocks should be bought essentially hand over fist. And Meta, seeing that their business still remains durable despite the tariffs and other uncertainty. Folks, that was Meta Platforms Q1 results. Q2 also looking real solid as well. Hopefully you guys enjoyed today's video. Make sure you check out Equity Empire. There's a new chat feature on the site. Even if you're not a member, send me a message. Hopefully you guys enjoyed today's video. Good luck with your investments.